All right. Welcome, everyone. Another fantastic episode of Let's Talk Markets Live. I'm your host, Dave Lauer, and thrilled to be joined by friend of the show, Erik Smolinski from Outlier Trading. Um, pretty, pretty quiet first full week of summer. Not much news to report. I don't know that we got anything to talk about, so we're just here to talk steak. No,
Yeah.
even before the trading week started, US and Iran traded missile fire. Felt like there was some more coming. Then President Trump announced that there was a ceasefire. And, if you watched crude and equities, seemed like the market took it pretty seriously, said everything looks good. Um, so that's what we're here to talk about. Erik, thanks for jumping on as usual.
A pleasure.
Always appreciate it. Um, So yeah, like what let's start at a high level. What are you
Let's
seeing in
let's dive
markets?
in, Dave. What did you make? We got to get you some like crack cocaine or something, get your energy up. So I'll help you out.
Okay.
I'll start with some heat.
All
So,
right.
what did you
Bring the heat.
think about the missiles? What was the game plan behind those? And I think there's a market effect here. That's why I'm asking.
Okay, fine. Look. I'll give you how I see it. I don't know. I
That's
don't
what I
know
would hope.
because who knows, right? Like
Sure.
it's really hard to trust anything these days. It's really hard to know what to believe and what's true and what's not. Um, my read of the situation is that this was performative in a way. Um, I'm not, to be frank, like I'm not really sure why, but I don't believe that much damage was done to Iran, um, despite dropping massive bunker busting bombs
Hell yeah. First
on,
time we got to try them out. It's awesome.
yeah.
Anytime we get to celebrate those.
I mean, yeah, USA all the way, baby. Sure. And always a good time when you get to display some military might, maybe send a message to some other people. Maybe that's part of what that was. Um, and then Iran, lets us know where they're going to strike in retaliation. They do. There was nothing there to strike because we had been given warning. Um, and, Trump uses that as a way to say, okay, we're good here. Let's try it. Let's now stop the fighting. Stop Israel and Iran. Like, enough is enough. Um, and then Israel says, with some bombs of their own, we're going to keep on going. But the markets don't seem to care. They seem to say, okay, crude especially. If you watch crude and what it did over the course of the week, it spiked up to around $74, down to 64. Not much higher than that right now. I think I just looked. It was a little, 65 and change or something. So like crude thinks that there is no reason to be concerned. No Strait of Hormuz closing is coming. At least WTI crude. So I don't know. Yeah, there you go. What about you? What was your take on the whole thing?
So tie that to the broader market. Like why do that whole thing?
Why? Yeah, that's the question, and I don't know. I you know
So
I I think some people think it was to distract from something, but it is not clear to me what.
well, you honed in on an important thing, is at least as far as I'm concerned, because
Okay.
from like a military perspective, it's not even close, right? So like the US is not even remotely concerned about Iran. They're concerned
Right.
about the potential, carry-on effects of any sort of armed conflict, and then the US appetite for that is low, but it's not like the US is like concerned.
Hmm.
So the engagement, at least as far as I could tell from all that, is really just part of like Trump's broader negotiation approach. Because if you look at the beginning of the conflict before the US even got involved, what happened to crude? Crude went up.
Mhm.
And Trump made it super clear that he does not want crude oil high right now. He
He
made that
did. Yep.
super clear. And it's because when you're sitting here raising tariffs, everything's about to get expensive. You
Yep.
got to be able to point at something and be
Yeah.
like, this thing's good. This
Yeah.
one
Yeah.
thing is good. So to me, this looked like exactly as you outlined, like a very performative way to tamp that down like pretty quickly, because as soon as Iran see the US is even loosely interested in getting involved in this, that changes the whole conversation, because Israel and Iran and Israel and its just general neighbors there, they've been lobbing grenades over the fence forever, right? They don't
Yeah.
like each other.
They do
So
not.
it's going to happen.
Truer
So
words have never been spoken. They do
that,
not like each other.
facts. Yeah. I mean, as soon as you have these really deep ideological differences, that's going to happen.
Yeah.
So the way that Trump got involved here was, I think, just a really good display of the way that he attempts to negotiate, which is through a certain level of chaos, like a certain level of absolute chaos. But the interesting thing that came through all of this, to your broader point, the market, it jumped, but still, if we thought the Strait of Hormuz was going to close where 20% of the global oil flows through, the US doesn't really get any, well, it doesn't get any direct oil from Iran, so we don't really care about that. Obviously, it's the ease of transit of oil. That reaction in oil still wasn't that crazy.
No, absolutely. I
Big.
totally agree. Yeah.
Yeah. So this to me was like, these kinds of things are straight gifts, especially
To a trader. Yeah.
oh my god, you like it's, I literally talked about it, and I am not good in any capacity compared to anybody else predicting the future. I have no idea what I'm going to have for dinner tonight, yet this is one of these kind of things where, like, if you give it just a few moments thought, this thing happened on Saturday, markets are closed, you know that the order book is piling up for futures open on Sunday afternoon, and you know exactly how that's going to go. Futures are going to gap. There's going to be a big initial move, and then there's going to be a rebound on everybody covering off of that initial move. It's like the most tradable thing on earth.
Yep.
So this was a very, very simple way to watch something, watch a new bomb go off, which was pretty cool, and then watch news sit there and talk about stuff, to your broader point, that nobody has any idea about what's actually going on, and then make money off of it. It's literally perfect. It's beautiful.
Yeah. So a trader's dream.
Yeah.
Outside of that, who knows?
Yeah, it is interesting more broadly, like if we think a little further zoomed out. But I mean, to your broader point, the markets are essentially saying we think that this is about over. I mean, it is worth noting crude is still slightly elevated compared to where it was in the high 50s, low 60s. It's still mid 60s. So crude is still showing a little bit of concern, but nowhere near as much. VIX is now back down below 20. So volatility itself is siphoned out in a pretty big way. What did you make of the robo taxi? Are you getting in one?
Yeah. I would get in a Waymo car, no problem.
Okay.
I will not get in a Tesla robotaxi.
Why? Why Waymo and not Tesla robotaxi?
So this happens to be a topic I know a bit about, in that I spent a year consulting in the automotive industry, and part of that was helping with software development for autonomous vehicles. So I personally don't think that cameras are sufficient. And I think that, we have seen that with the way that the so-called full self-driving, which is not full, has performed.
Why do you say it's not full?
What is it? It's like it's what level is it? I don't even remember now. But it's not level 5. Level 5 is full self-driving. NHTSA level 5, right? It's not anywhere near that, which means that it can drive in any conditions and in any place. So it's not full. Full is level 5. That's like there is a regulatory definition for what full self-driving is. This is just marketing. And the cameras they're insufficient. They can't distinguish between things that LiDAR can help with. So Waymo uses LiDAR, these lasers. It's much more expensive and it's much safer. And
what is that critter on the ground behind you?
Oh, that's my dog.
Dog. Okay. I just want to
Yeah,
make it. It's a blurry mess, so I can't tell if it's a dog or
yeah.
a cat. But
I
now I
don't want to
feel
show the house, but yeah, it's his
nope.
name is.
I'm satiated. I now know. Sorry.
But you need to know his name is Mutt,
That's a
and
perfect
it's
dog
the
name.
best, right? It's the best, and
That's
he's
what my
yeah,
uncle had a dog named Dog. So
yeah.
yeah,
I
I
love it. I love
that's
it. That's
perfect.
definitely going to be another one of my next dog names.
Okay,
But
sorry to
all
interrupt
right,
you.
yeah,
My ADD got me
no
back
worries. Yeah,
to full self-driving and how you like Tesla.
yeah. No, I don't think their tech is good. I don't think their safety record is good, and what they have this thing where, like, if you're using their autopilot and about to get into a crash, it disengages, and so the crash doesn't go on the record of the autopilot. It's on the human, and so I think it distorts their safety record as well. So it's just not something that I would do. I care when I was in the automotive industry, it was solely focused on safety, and that
Lame.
yeah, I know. Very boring. I did get to see a live crash test, which was really cool.
That's actually
And
kind of
I
cool.
I did get to be in the car with a professional driver going 170 miles an hour on a test track. That was also really cool. I enjoyed that experience, but it gave me a newfound appreciation for safety
Yeah.
in automotive, and
Yeah.
that's mostly what I care about now when it comes to cars.
Yeah, well, it's really interesting. My buddy had one of the newer models. He was out here visiting, so he did like a churro, and he got like one of the new models with again like the FSD, like the partial FSD.
Hmm.
And we, I mean, we put a few hundred miles on it out of curiosity, and I'm not gonna lie, like I genuinely was impressed.
Uh-huh.
It did a fantastic job 99% of the time. The trick was 1% of the time it tried to murder us, and it's in that
That's
small
the trick, my
it's in
friend.
that
That's the
small
trick.
1% of time where you almost get murdered and you're like, we still have a couple of quirks to work out of this
Right,
thing.
right.
So for me, it was coming on the 5, which is a pretty fast freeway in California.
Oh, I've driven that
Yeah.
road very
And
fast. That's a
there,
fun
there was
drive. Yeah.
there was a little bit of like a guardrail on one side because of construction, and then like standard California, the person in front of me was doing like 35. So
Yeah.
then there was a person one lane over doing 85,
Yeah.
and the
Right.
car was literally just like literally putting us in the middle of it. So I
Man.
gave it as long as I possibly could before I directly intervened, but I intervened before it started to even just turn itself off. Because
Yeah.
then I thought to myself, like, damn, how long do you wait
Yeah.
before you turn? Like, because this is this is like different than like Jesus take the wheel, Elon take the wheel. Is I'm not trying to do that. I'm trying to take the wheel
No.
because I'm in this thing.
Right.
But I
And
was
and what's messed up, what I find messed up is that this is technology that is in its beta phase, right?
yep.
It is being beta tested, and it, people's lives are in a beta test, and other drivers are not consenting to that beta test.
Well,
Right? Like that guy
I
going 80, if you hadn't taken over and he had slammed into you, that's like,
I mean that dude
right?
shouldn't have been going 20 miles an hour over the speed limit in the right lane. So
Okay,
I
yeah,
like
sure.
screw that guy. I like he already consented to not care by driving the way he was driving. But I think the big
But it's
caveat there,
I-5, like that's how people drive there, right?
I think it is, but and I also think that's actually why there's a really strong argument that self-driving literally even in a beta is safer than regular people driving. Because I think
Sure,
until you
that's always the question, is like accidents
yeah,
per million miles and fatalities per million
yes.
miles driven. And
Un-
sure, like that's I'm a big believer in tech. I am like I believe that in fact I was pretty sure that my kids would not even end up getting driver's licenses
really?
because I thought autonomous tech would be there within the next few years to such an
Wow.
extent that that wouldn't be necessary. And man, what a great thing that would be. I'm sorry, but like fewer teenagers learning to drive on the road, that is an unmitigated good thing, right? Like,
That sucks.
come on, it sucks, but it's like it's a different world. It's going to be a
Dave,
different world. We
you
have
need
to
a little
embrace
risk in your life. A little risk is good. You need a little
that.
risk.
Yeah, my
You
wife
need the
says
16-year-old
driving with me
trying
is
to
a
text
risk,
and take a
but
selfie and
yeah.
doing the merge across six legs. You need a little of that. It keeps you alive. Don't become a bubble boy on me.
Yeah, we got the chat, and Dave said you should see how I drove as a teenager, and don't worry, there was some risk there. Yeah.
Yeah.
But
Yeah.
man, I could drive from Boston to Philly in like under 4.5 hours.
Easy.
Yeah, that was great. I
You
was so
just
good at
mob
that.
it.
Yeah,
Yeah.
yeah.
Yeah, I think the progress is really interesting. I think the technology is super super promising. I think it's going to be slow specifically because of that. I think it's because even if we start getting broad data about how good self-driving is and how better it's got to be on average than like the general population.
Look, again, the LiDAR-based systems, ton of evidence that they are excellent, and that they are far safer than humans already. Um,
Mm.
the ones that are just like Tesla, which is just based on camera tech, not, I haven't seen the evidence there, and I don't trust their data because of the way it disengages and they juice their numbers.
I see. Yeah. So then is there a way to track like number of disengagements during a drive?
Yeah, I have seen some of those reports before,
Because I think that would give you
but
a
I
proxy
don't
at least.
remember it, off the top of my head.
I was
So
thinking that.
some of that is reported now that they didn't want to, but they've had to
Got it.
start reporting stuff that they don't want to.
Yeah, because I was thinking that that could be a decent proxy at least for like number of potential, right? Because then you could take a subset of the disengagements that would turn into an actual crash.
Sure. Yeah. Yeah.
Yeah.
I
Curious.
mean, that's the other thing that, again, like to your point earlier, generally speaking, people are terrible drivers. So the idea that the tech can be better than the average driver, really not hard, um, to get there.
Riddle me this, Batman. Why is it that in biotech, why is it that insider trading laws aren't stricter for people in that industry?
Hmm.
Why?
I mean, I like there's a consistent answer to this type of question through the ages, and it's corruption, right? Isn't
But I
that
feel
just
like
the answer?
why biotech? Like there's plenty of other places that get pinned, but biotech seems to have this big pass where like people that are going to closed door symposiums can still trade.
Yeah.
Cuz I mean, peek behind the curtain, a lot of those people are smart, so they use options for leverage. So
And
you could see them.
you see this.
You can see
Yeah.
them when it pops up. And I
Yeah.
got to be honest, their timing is pretty good.
Yeah.
So, but it's never perfect. So I
Mm.
literally have an entire process built around dovetailing off of options flow in biotech stocks because of this very thing. And it has a disgustingly good hit rate. And it's bad. It
So what are
shouldn't
you
be
complaining about?
because it's so blatant
Yeah.
that it just it shouldn't be a thing. I'm happy. Like we're cool with it. Just like the people that can copy Pelosi, they made like 54% last year. They did all right. So, but I find that gap so interesting.
Yeah.
From a market making lens, how would you guys deal with that side of the business? Because I know making markets in biotech has got to be less attractive.
Oh yeah. To be fair, not something I had to deal with. Like I don't recall off the top of my head. One, caring about industry, but two,
Okay,
like a lot of the market making we did ETF market making,
got it.
or um, and the ETF market making was generally broad index, so there was no biotech in that
I
though.
see.
Um, and then interlisted trading U.S. Canada, and I don't think there's much biotech that's cross-listed across the border. But to be fair, like you would see in plenty of names either one-sided flow, in which you tend to like either pull out of the market or blow the spreads out because you're gathering all this inventory and you need to unload it, um, or uh, from an options perspective, like if there's massive options volume, you're going to hedge like crazy, right? You're going to try and stay delta neutral, and so you'll slam into the stock market if you're getting like really crossed up on the options side. You'll slam the stock, and that's often that's why in lead lag studies you'll see that, sometimes the stock will lag the option.
Yeah, can we work through an example there? Let's say that there's company XYZ, and let's say that the current total open interest for the entire options chain, let's say there's no weeklies, so just monthly expirations, standard illiquid biotech. And let's say that there's 3,000, 5,000 total OI, whatever. And let's say that you start to see long calls coming in that are less than 30 days, 30 delta, 20 delta, kind of a little bit out of the money, but total volume essentially exceeds entire OI. And then it persists for like 2 or 3 days.
Right.
How do you guys behave there?
So again, I was not an options market maker, although the desk was next to us. So, but my understanding is that a lot of the time they're not going to go full delta neutral right off the bat, right?
Okay.
Like they're because they're just like you're saying, like there's no you have no idea if it's going to persist. But they'll hedge a big chunk of it.
Okay.
And then as it continues, they'll continue hedging, and you're trying to reduce your hedging costs at the same time, right? So even if sometimes you're going to slam into the market, if you can avoid it, you don't want to. You want to hedge intelligently, or hedge in correlated products. You can do that too, right? Like build an optimized portfolio based on cross correlations. But that's like not something I ever did myself. Just something.
Because that process got to be fascinating, trying to be able to take into, I'm sure the models can do it now. I mean, they got to be so smart, but just take into account even the volatility surface on that's got to be crazy.
Yeah.
And to come up with like a good correlation matrix on that.
Right. I mean, what about you? Like, because you're not just in and out, right? Sometimes you've got longer term holdings, right? Are you hedging out your Greeks, or
No.
So you're making bets based on those.
Yeah, man. Like it's very infrequent that I'll hedge, only if I'm either if I'm sizing, which I really don't do anymore, or if I'm like truly trying to isolate a volatility effect, like implied volatility expansion into an earnings release, right? Like I can measure that across names. I can come up with a factor, and then that I will delta hedge. So like I'm trying to gamma scalp just to subsidize the holding cost. But it's like pretty infrequent that it's just expensive. Like the total cost there. And that's one of the trickiest things I think for retail traders is that like when you see zero commissions, it's so easy to think like, oh, this is free for me to do. And it's like, no, dog, it's not. It's never free. It will never be free. So,
if you take nothing from this podcast over the years that we've been here, just know that free trading ain't free. And there is no such thing as Wall Street giving you something for free.
What do you mean, Dave? Those price improvements are so nice.
Oh, so nice.
They're
Love
just
pennies.
They're just good people.
Just good. They're generous, right?
Yes.
Like that's what, when you think of
right.
large firms on Wall Street, you think of their generosity.
Obviously. I mean, I saw Wolf of Wall Street when he was throwing the money off the boat. Right, he was throwing money at people.
Very generous.
He was giving fun coupons out. That's nice of him. but yeah, I think the broader world, especially like trading biotech, there's well, okay, that's a lie. Like you could hedge, but man, it's not like the edge there is that big to begin with. So as soon as you start trying to hedge off too much of the ancillary risk, then
these are thin names, right?
Yeah, you're left with very little. So. Yeah, you just kind of
be sure like these guys lose a good amount of money on those kinds of trades.
That's essentially what I was like. I have a big tracker specifically for biotech, and there's like certain factors that have a realistically high correlation to near-term directional change. But yeah, that's a great question from Richmond. It says, so at what point does payment for order flow go away? It's clearly just a competitive advantage to the few, stealing from the many. Feels like the regulation will be impossible in my lifetime. It's my opinion on that is, at least from a retail side, you kind of have to accept the continuum, because I think it would be hard to argue that payment for order flow or the structure that we have now is worse than what things were 30 years ago. I don't know.
I hate that argument.
Why do you hate that argument?
That's like, that's the argument that they all, Citadel and Virtu and
Oh,
all these brokers, and
let
they'll
me
be like,
finish.
you have no idea how bad it was
Let
20
me
years ago.
finish the
And I'm
argument.
like, give me a break.
Let me finish the argument because I
Okay,
do agree with you.
okay, go ahead.
But I do think it's important to at least acknowledge the fact that markets objectively are cheaper and more liquid for retail now than they were previously.
For sure. But
That
basically, the argument is we're ripping you off way less than you used to get ripped off. You should be really
exact
happy.
exactly. And that is the ultimate kick in the nuts. Is
Yeah,
the fact that
exactly.
as good as we can argue that it is now, it is so objectively off from where it should be. It's
Yes,
insane.
exactly. Right. And
Yeah.
so, like I said before, like I'm a
Yep.
big believer in technology, right? And technology should have revolutionized markets, but
Mhm.
it had incremental effects. And they're going to say, well, look at liquidity, look at this, it's like, give me a break. You don't, first of all, volume is not the same thing as liquidity, though they want
Mhm.
it to be and they claim that it is. But the perfect example is like the flash crash was one of the highest volume days of trading and one of
Right.
the least liquid. All right. So don't tell me volume equals liquidity. It doesn't. And the other side of it is the effects that it's having on markets are dramatic, right? If spreads are 25% wider than they would be in the absence of internalization of payment for order flow, that's a multi-billion-dollar a year cost. And to me, that's a big number. I know like billions, we throw that around now and nobody really cares, but like, you
Now,
know, that's a big number to me.
how do you think though about some of like the genuine benefits that do come with that cost structure? Like the fact that I can work a bid ask spread and there's no cost for me to cancel an order that's routed.
Because the payment for order flow, the SEC quantified it in their equity market structure proposals a couple years ago, and it adds up to something like 20 cents per order. So you can't tell me that they're not charging
I see.
$20 commissions because
I
they're
see.
getting 20 cents an order.
Right.
So, and there are markets out there like Canada, socialist paradise over here, where there is no such, you are not allowed to pay for order flow or internalize,
Yeah.
and
You
they're
guys got
still
some
free trading.
you guys got some hot markets over there. Let's trade the Canadian markets, eh?
And I mean, Canada has a tough time with the U.S. being, the main liquidity center south of us, and a lot of the stocks being cross-listed. And there's a big incentive for brokers to trade in the U.S. instead of Canada because of payment for order flow. It's a serious problem.
Yeah.
Um,
So then zooming out to the question here, like not in an idealistic sense, because it's so easy to be idealistic. What is practical practical path for payment for order flow to go by the wayside? Like what is a
well,
realistic way?
practical means that there's a chance regulators will go for it. And as Richmond here is saying, it feels like regulation will be impossible in my lifetime. In Richmond, it feels, look, I'm not giving up. I've never given up. I've been trying to end this practice for like 13 years now. And we had a chance with Gensler. He made the right proposals. The industry pushback was immense. It was really like scorched earth. And now we have a new SEC chair, and he has scrapped those proposals. So, that's the answer right now. With this SEC, Trump's SEC has said the system is great. It is working wonderfully. No changes are needed. In fact, we want to eliminate past changes and reduce regulation. And while I am all for reducing regulation, the problem is that they're not looking at reducing the things that I think would make things better. They're looking at
Speaking
reducing the things that are there to protect investors.
speaking of regulation, why is it that naked shorting is still as profound as it is? Obviously, the easy answer is the powers that be want it, clearly. But why?
So I'm going to lump in. I like to call it abusive short selling because
Hell
some of
yeah.
it, some of it is naked, but some of it is not, and it still
Close but
abuses the
abusive.
system, right?
Okay.
There are still problems. It still is usually associated with market manipulation. And look, when it gets down to it, the reason we have naked shorting, which is um, people will say, no, that's illegal. We don't have it anymore. It's not true that we don't have it anymore. It's actually legal because of the Bernie Madoff exemption in Reg Show, which says that market makers do not have to locate or borrow shares before they sell short, which is the definition of naked shorting. And we see failures to deliver consistently, billions of dollars a day in failures to deliver. And we see stocks on the Reg Show threshold list, which is only possible when failures to deliver have been maintained above a certain threshold for a certain number of days. So this is obviously still a problem, and we have it because people are, quite simply, people make money from it. That's all there is to it. They're making a lot of money, and they're very powerful firms. They're the ones that tend to influence regulation, and so there's an effort up here in Canada to address this issue, and it's getting crazy pushback from the brokers. We've been pushing in the U.S. We did a petition for rulemaking to end this practice. The SEC has not yet even taken it up. We have put an executive order out there that Trump could sign and fix the problem like that. So far, nothing, but we hope that we'll get some progress on that. So, there are simple rule changes in the U.S. that would address this issue, which include a mandatory pre-borrow for all short sales. So no more locates, no more reasonable grounds, legal terms that lawyers can drive a truck through. You want to short something, you have to borrow the shares. That's it. That's how shorting is meant to work. Also, to introduce fines for failures to deliver, which is how the U.S. Treasury market works. And they fixed the settlement failure problem in U.S. Treasuries by implementing fines and ending this market maker exemption in Reg Show that allows market makers to do whatever they want.
What is the actual plumbing path on how it's used? So from, let's say, a market maker lens, like what is the actual path that they're profiting from that?
So they're if you take them at their word that they're not naked, these stocks, that they're just in and out, they are at least saving the cost to borrow those shares, which there is an associated cost.
Yep.
So that's a problem in itself, because that means that markets are not operating efficiently because they're not reflecting a cost that there should be. If you consider the fact that they often end up with sizable short positions, even though they deny that, but we can see it in the data that they do, then by creating supply out of thin air, look, it's like you couldn't get more simple in terms of economics, right? You have supply and demand, and together they come together, and there's an equilibrium price. So if you artificially increase supply, then the price is going to drop without a change in demand. It's that simple. And if they're short and there's a lot of one-sided flow of people buying, and people are buying and buying and buying, but there's little price impact to the buying because they're shorting, and they're as a market maker, filling those orders without borrowing the shares, then the impact of the buying is muted, and it pushes the price down because of the increase in supply.
And a function like Reg Show, when somebody shows up on Reg Show, what is the typical path that they would resolve showing up on Reg Show, and what's the forcing function? And also, by the way, I have to apologize because I think we've covered absolutely nothing from that agenda. We have gone way far and left. So,
like, hey, where are we? How did we get here? What's going on?
Yep. So this is inside my brain. This is how shit goes. It's here we go. So
that's why these episodes with you are so fun.
Yeah, because they're
no
random
apology
AF.
needed.
But So for like, what's the resolution process for an entity that shows up on Reg Show to like efficiently make that happen?
Yeah, see, actually, it's all Richmond's fault, so
Okay.
don't,
Yeah,
don't
good.
worry about it. Yeah,
It's good to have a scapegoat. I
Richmond.
have
Yeah,
learned that the power of a
exactly.
scapegoat shouldn't be understated.
um, so the resolution is that failure. You know what? Here's this is actually a fascinating question. I'm really glad you asked it.
I
So,
know it is.
um, because I was talking about this with someone who is an expert in these issues, and we were actually talking about this directly with the SEC. And when a stock goes on the threshold list, they it is supposed to introduce a mandatory pre-borrow.
Mhm.
So now everyone has to borrow before they short. However, it is not 100% clear in what the SEC has written on Reg Show and provided in guidance that that is actually the case. And again, there are lots of lawyers out there who ensure that their clients can do what they want, how they want to do it, make a lot of money, and not face regulatory scrutiny.
Hell yeah.
Um, and so this is part of that. So if mandatory pre-borrow was being followed, you would expect to see something go on the Reg Show list and come off. But instead, we see companies on it for tens of days, hundreds of days, even more, because that's not being followed. We see ETFs on it constantly because there are benefits, again, to the market maker to not having to borrow those shares in terms of profits. And so like this is one of those issues where we are saying actually to the SEC, just issue some like super simple guidance here. This is like the lowest hanging fruit there is. If something's on the Reg Show list, be very clear that there's a mandatory pre-borrow. And so I don't know. We'll see that, you know, maybe we'll see something on that.
And what's the mechanism that they avoid the pre-borrow then? So if they're on Reg Show, they interpret it in a way where they wouldn't have to pre-borrow. So then they just continue plugging on. But wouldn't that push them further on the Reg? Because like we typically see it rotate on and off. So
We
there's
often see that, but we often see stocks stay on there.
I see.
Yeah, and so
But
like
like,
that's the if you look at the study that John Welborn did, which it was attached to our petition for rulemaking
okay.
to the SEC, you know, he documented this exact issue, and he showed that sometimes stocks are on there for hundreds of days at a time, which
Yeah,
is practically inexplicable if the rules are being followed.
I
Big
see.
if, obviously.
And then when the companies are on the list for multiple periods in a row, why do we see the total amount ebb and flow so much versus one directionally just expanding?
Yeah, I mean that I'm not like, you know, you're past my
Okay.
expertise on this.
You make it up
Um,
because I don't know. So I would
I
believe
know
it.
you would have no idea, right?
Yeah, I would believe it. Yeah. Okay, fine.
See,
So then,
hoisted by my own intellectual honesty.
yep, fine.
Yeah.
So then my next question is what do you think about the ETF structure right now where something like S&P 500 is now over 30% tech? Like the original imperative of the S&P 500 has changed so much. It's effectively become Qs, and Qs has
Yeah.
become Qs on crack. So
Yeah.
like from an ETF
The
world,
crack is AI.
yeah, right. That's you put that in earnings, you're now a tech company.
Yeah, that's it.
And so what do you think the path forward is for an index like Qs? Because I've seen actually a pretty significant rotation into stuff like RSP, which is an equal weighted S&P 500 index,
Mhm.
because people are like trying to find, I think, something that's a little more
A little more
representative.
diverse. Yeah.
Yeah. So, but what do you think happens with something like S&P?
Yeah, I don't know. Like passive investing is it's really good for saving for retirement, and it is questionably good for markets and price discovery and corporate governance. And you know, a lot of these ETFs own giant chunks of these companies, and sometimes they get involved in ways people don't like, and sometimes they don't get involved and people don't like that. So like there's a whole corporate governance question wrapped up in that. But yeah, I mean, I think you're right. Like we're in the middle of a massive tech and AI bubble. That again, there's a great saying that markets can remain rational longer than you can remain solvent. And I believe
We got to
that's what
introduce
we're
those people to some margin, dog. You can just margin up.
Might have the opposite effect there. But that's what, it's easy enough to see you're in a bubble and hard enough to know like when that's going to change.
Right.
And it's really difficult to be right twice, right? So you have to be right calling the top, and you have to be right getting back in at the bottom. And if not, you're likely to miss out. So, we've told everyone buy these index funds. This is what you need to do. And on the whole, that's good advice. But
Standard.
in the midst of a bubble, those index funds are becoming less diverse. I think that's like an excellent point from you. And so, people should be better understanding what they're buying. This all goes to investor education, and make sure that you're diversifying enough, because it's getting harder. And the most liquid ETFs are getting less diverse.
One of my biggest gripes is the balance of diversification, because I feel like people tend to fall on extremes of a spectrum. Either your concept of diversification is full port margin up on an individual name,
Mm-hmm.
and the name has like two sources of revenue, so now you're diverse. And then there's the other people that are like, I need to hold at least 65 individual stocks in a portfolio in order to gain diversification. Meanwhile, their portfolio effectively doesn't move.
Mm-hmm.
So how do you think about that concept of diversification from like a practitioner's lens? Obviously, the caveat, it's gonna be super personalized. It's gonna be based on the individual.
Yeah.
But
I mean, I think when I'm looking at long-term savings, that's the problem. Like I think we're talking about, I don't know if we're talking about two different things. This is actually something I had on here to talk to you about. So let me turn it around first. Let me turn around and ask you a question. I think my understanding, you have a short-term trading portfolio and you have a longer-term portfolio.
This is wrong.
Right? You have nothing long-term.
I have one portfolio.
Okay. You have lots of short-term positions, different strategies.
Yeah.
And then you have longer-term holdings in your portfolio.
Just not to be pedantic, but just to understand so I can answer appropriately, like what do we consider short-term and long-term in this context?
I'm going to say long-term is multi-year.
No.
Nothing. Yeah.
No.
Okay.
No way.
No multi-year holdings. No.
Yeah. There's like a long-term holding for me is like once we start getting outside of like 8 months, that's long. We're in this thing.
Okay.
The main reason, at least for my general, like again, like as a slightly more active trader, there's so much that you can amplify in terms of a return without even being perfect. And that's the thing I think a lot of people mistake is like they'll say like, oh, I'm going to wait for a pullback, or I'm going to wait until it's a little higher to sell. And it's like, even if you capture 40% in on both ends, now you do have to be thoughtful in terms of friction, total friction, right? Like what you're generating in terms of taxes and stuff like this. This is where options and leverage becomes very useful. But even being quite sloppy in terms of like those timing elements, you can easily outpace that. So I have a couple things that I hold long-term. I have one stock that I made a bet with a viewer during a live stream a couple years ago, that one I told him I would hold until I die. And it's literally just because it's a bet. So that's going to be there forever. That will be my longest holding for sure.
Okay.
And then, but beyond that, I mean, like even in retirement accounts, I trade those. Everything's traded.
Okay. All right. So that's different, right? Like I'm not an active trader. I will sometimes, like often, but like sometimes put trades on just because I like to trade. Like I enjoy it.
Hell yeah.
And I'm often good at finding some good opportunities.
Take your drugs, man.
Yeah, whatever, it's fun. But most of my holdings are set it and forget it, because I don't. I know that like my time is better spent in other pursuits.
Mm,
That's just a personal, determination. It's not a judgment in any way. It's just like, there are other things that like I want to focus more on advocacy, and I need to spend the time to do that, and I need to stay on top of things. And I like building startups, and I like building products, and I like helping companies. That's what I want to do. So because I am not spending the time you're spending, I know I can't be effective at actively trading. And so when I'm thinking of diversification, I'm thinking of it, as a set of ETFs where I own different industries and different asset classes and different regions around the world. So it's a very diverse long-term portfolio that I try not to ever think about or even check the value of, because that will invite, activity. So
intervention,
I
yeah.
so I have a totally different account and broker that I do any trading that I do through.
Right. That's like it's funny how people find those kind of microstructures that work for them, right? So like it's like completely separating these two. And
Yeah,
then but I think it's important to call that out, right? Because some people they might struggle with that kind of thing, and you found and you're sharing a common solution that I've heard a lot of people talk about, which is
yeah,
doing something like that, which is I think a good call out. Now the funny thing is, I'm sure with a lot of the ETFs that you're holding, even though it's considered buy and hold, a lot of that realistically is still a momentum factor, because
yeah,
depending on the ETFs that you're holding, they're going to keep the winners, shed the losers out of the ETF.
yeah.
So it's almost like you when people buy and hold an ETF, a lot of times I think they get confused with what that actually is, because you're really trading a momentum factor. That's
Yeah,
just
for sure.
yeah.
Some of them are, I would say, funds that are more quantitatively sophisticated, because I like that kind of thing and I appreciate what they do. But for sure, all of them are looking at different factors.
Mhm.
But yeah, momentum is, I mean, like just as you're talking about with like what the S&P has become, that's because
Yep.
of momentum, right? Like
Right.
that's how it works. And that's been a good trade for the last few years. I mean, it's been a good trade since like 2009.
So you talk about a bubble, and it's a really common talking point, because that angle very frequently scares people and it draws attention, right? And I know you're not doing it for that,
Hmm.
but that's a common reason why people will attack that angle for sure.
For sure.
Now, to your exact point, though, that we started this next leg essentially post GFC, and it's been 2 decades we're coming up on, and we're just still tech is
Wild.
dominating.
Just wild. Yeah.
So, how do you think about this concept of a potential bubble? And what are some of the things that you believe you would see that would signal that the bubble is starting to burst?
Hmm. I I think that everyone's always hesitant to say this time is different. Um, and if you believe this time is different, you believe it for a valid reason, because there does seem to be this dynamic of funds just flowing into equity markets, just flowing and nonstop. The spigot, it is unclear what will turn the spigot off. And a lot of people are convinced, rightly so, that their retirements need to be in equity markets to
Mhm.
grow. And bonds have not, up until very recently, offered any kind of material return. And so there's just this money that every month everyone puts in, right? Because that's what you do, and that has created this floor in the market that keeps going up and keeps going up. So if there's any reason to think that maybe this is different at the moment, I think that's what it is. And this idea that it's driven by the Fed and this massive amount of liquidity that they injected into the system and have not, exactly withdrawn, but have at least slowed down the injection of. I think that's a very valid point. But what would you? It's really hard for me at this point. Like, I don't think you're going to be able to see it. I think that's the nature of bubble bursts. That you want to look for things, but if you're seeing it, everyone's seeing it. It's going to be such a violent change, right? It's another saying in markets. It's an escalator going up and an elevator going down, right? Like it is going to be such a dramatic drop that there is going to be no doubt, but it'll be too late to have done anything other than maybe you're buying protection along the way and that protection pays off. But that's a pretty expensive prospect. And again, it hasn't been shown that there was a really great book actually, and I would really recommend. I like Scott Patterson a lot. He was a reporter for the Wall Street Journal. He did a lot of stories on market structure. He wrote a book on dark pools, but then he wrote another book called Chaos Kings, maybe a year ago or two years ago now, and it looks at Taleb and a couple other people who will, one of whom will say you can predict bubbles bursting, and they've got this what's the name of it? It's the Financial Stability Observatory, I think it's called. I should probably look that up. It's super interesting quantitative analysis on trying to directionally predict the market versus this other guy, Universa, which is a hedge fund, who says you can't do that. And so therefore you buy protection every day. And when it pays off for the cost of being wrong for years at a time.
I hate that.
Yeah, I know. And it's something that I've tried to do and I can't make it work because of the
Yeah,
cost of the strategy. And it's
because I
so
well, I mean, depending on the details, like it doesn't work. Like that's the thing. Like if you are paying for persistent protection that you know is overpriced, then there is not a compensatory move unless like you are talking end of days kind of moves. But
well, think of 2009. Think of the dot-com bubble in 2000 and 02. Think of other crises like the Asian flu in 96. I'm sorry, 2008, not 2009. Think of the like these bubble bursts. We've seen them, and they you can talk about a 60% drop in equities, right? Like, are you like ready for that? Not you, Eric. Are you, the viewer with savings in ETFs for retirement, ready for that? Are a bunch of people who are about to retire and who have their money in equities ready for that to drop to happen? Like that can and has happened many times.
But that's also why, as you get closer and closer to retirement, they tell you take your money out of equities because
Absolutely.
there's
Because of
an
that,
inherent
right?
timing component to it.
But it's a problem when fixed income isn't paying much.
It's a
And
problem,
there's
but
inflation, and as this comment makes, like, this is what we're talking about. Like, you're kind of forced into the market, and Social Security not keeping up, right? Like you are forced into the market, especially in the US in a lot of ways.
you're not. It's not true. You're not forced into anything. Like there's
Okay, I mean,
yeah,
sure, but like, the incentives are there to drive you to the market. Let's say
which
that.
in which case I think the incentives are equally there where if you're getting to the point in your life cycle where you're like, I'm going to need to withdraw this money soon, well, then even inflation being high, that extra 1 year of return isn't going to be the difference between this working for you or not. So like at that point, that's when you obviously start getting within that window. You have to scale back your exposure if you're that price sensitive.
Yeah, you
So
hope, but what if you're wrong about how long you're going to live, right? And you're going to live much longer than you thought. Like
at
people
that
talk about
point,
retiring in their 60s. You could have 20 more years.
at
That
that
that didn't
point,
used
you
to be the
just stop
case.
caring. That's the beauty of being old. You just don't care anymore.
Well, it's easy to say when you've got the savings to
Definitely.
support it, right?
Well,
So
and I mean,
I don't know.
re-
I don't
re-
know.
realistically, even with my mom, like I support her.
Right.
So it's like I'm actually very sensitive to this exact topic
Yeah,
because
yeah. My mom too. I'm the same
yeah,
way. Like,
yeah.
I help her, and she's constantly asking me like, do I have enough to retire? But she's not listening to the answer because she does, and she won't listen to me.
Right. Well, it's because
She's
it's
a boomer.
concern. And it's like genuine concern.
Yeah.
But I think the interesting thing with the dichotomy here, though, is like I also would argue you can typically tell when markets start to crack. Like you can typically tell if you go back at all of those historic references, there are things that look a little bit different. The problem is if you're not a trader, then you're kind of stuck, right? Because there's no way to perfectly time it. You're going to get
So how
whipsaw.
would you approach it then? So what would you see that would tell you this is
It's
not just a drop, this is something serious about to happen?
Yeah, it's highly specific to what the broader economic regime is, genuinely speaking. So that's a huge factor. Like, are we in an expansionary contraction environment? Those details would color things slightly differently. But the easiest way that I would start the conversation is remove all of that and do a basic statistical analysis of something like SPX, and you can plot what the average daily, weekly, monthly, quarterly moves are as a total percent range. And you can create literally a distribution that shows you the frequency of these different things. So then if the average distribution to a downside over a 3-year period maximum is down 15%, and then the market's now showing down 18, 20%, you're now met with a choice. And you can even quantify the frequency where if the market exceeds whatever that lower threshold is, what's the frequency that it then continues? And then you just make a business decision. You say, okay, if it gets down to this point, I get out. I accept that it might be wrong. And then if it starts to rally, I'm never going to perfectly time it. I'm going to take a little bit of a loss, take it on the chin. But I now have the safety that I'm not taking the market for a 60% downturn. And that's way cheaper than trying to come up with consistent protection cost via buying puts or some other method to do so. So the easiest way, I think, for like somebody that's not looking at all of the other micro factors, right? So like analyzing volume behavior against price action, tracking things like net highs, lows, like all of those help paint an aggregate picture that never tell you what's going on, but it gives you a higher probability sense of what this
But
could
how
look
many
like.
times since 2009 would that have triggered incorrectly? And
Let's
I can
see.
tell you the answer is definitely 3 that I can think of off the top of my head.
I mean, if I was going to go more than 3, but
Yeah, I mean, I'm just,
it's,
that I know of.
yeah. So
And
again,
you'd have been wrong.
no, you're not wrong. It's not making a directional trade. You're not doing that to try to, in this context, to try to profit from the downside. You're simply taking an objective removal from the market to limit your downside risk. You still limited
Correct.
your
But
downside
you
risk.
would, no, because you would have pulled out at or near the bottom and then missed the very fast bounce back, which that's partly the problem here is that the hallmark of corrections since 2008 has been that they are viciously fast and bounce back crazy quickly.
I mean, we got to be careful with our language, because when we say viciously fast, that would lead somebody to believe that there's no way for you to get involved. Whereas if we take a look at a peak to trial move from the recent drop that we experienced in the end of February, so it was over the course of 34 trading days, 46 days, the market dropped about 20%. The market started making its primary recovery the like 3 or 4 days after the bottom, but it didn't start making a meaningful recovery for 2 weeks, 10 trading days, 11 trading
Yes, but
days.
that again, this is first of all, it's a level of activity most people aren't capable of and aren't
Look at the
managing.
market once a
But yeah,
day.
yeah, I mean, no, they're not going to be able to manage it because they don't. And if
Sure,
they if
sure.
they do, it's a very small percentage of people.
Sure.
But
No,
yes, I get what you're saying. Like,
I fully agree with that.
but here's let's cap it here, because this is like a super fascinating conversation, and I would love to have it with you after you've read Chaos Kings
I've read
and
that.
looked at you have
I have,
the
yeah,
book?
I definitely read Chaos Kings. I think you
Oh,
recommended me to that like 3 years ago.
I did, yeah.
Yes.
And then go check out. It's called the Financial Crisis Observatory.
Okay.
And again, Didier is on the side with you. He will say that these things are predictable and tradable.
Yes.
But then there is a massive volume of academic research that says that they are not. And it's a
I mean,
fascinating debate to have, but
it's
it's still questionable whether this is all possible.
yeah, and I know that you said we got to wrap, so I think
Yeah,
it's I think it's a really interesting concept. I mean, I think we know based on same academic research that we can accurately time markets through things like momentum factors, growth factors. Like you can time. But to your point, it does come with noise with the signal. So
right,
the
right.
issue is that it will never be perfectly predictable.
Yeah.
So
So
completely
maybe
agree.
you know what would be cool? I will try and get um, Sornet. I'm probably Didier Sornet. I'm probably butchering. I'm sorry, Sornet Didier. No, his name is, yeah, Dr. Didier Sornet. I apologize if I'm butchering your name, but I will reach out to you and see if maybe we can get him on the program and talk about it. That'd be a fascinating topic of conversation.
It'd be super fun.
But Erik, as always, fascinating, not anywhere close to what we had planned on, and still
Perfect.
well worth it. Really appreciate you coming on and being our final guest for this season of Let's Talk Markets. We're going to take a bit of a hiatus
That's
over the
right.
course of July. It is just too hot to record podcasts right now, but we'll be back in August at some point, and we'll keep talking about markets and where we think they're going, and hopefully people are gaining something from this. Just this fascinating banter, I'd imagine.
Beautiful. Great catching up.
Yeah, as always. So thanks, very much to everyone who tunes in and listens on YouTube and on X. Really appreciate all of you, all the comments. It's great to see you too. And we'll see you back here in a little over a month. All right. Thanks, everyone, and have a great summer.